What is a cap rate and how does it work? A cap rate is an interesting term, and based on Investopedia.com, it is used in the world of commercial real estate to indicate the rate of return that is expected to be generated on a real estate investment property. This measure is computed based on net income, which the property is expected to generate, and is calculated by dividing net operating income by property asset value and is expressed as a percentage. It is used to estimate the investor's potential return on their investment in the real estate market. So how does it work? Meaning, what elements go into determining what a cap rate is and what is a good one versus not? Let's start off with the elements that go into a cap rate. First off is the location. The cap rate or rate of return on a property will be very different depending on geographic location. Properties in major metropolitan areas are considered less risky. Why? Larger areas bring more people that could potentially lease the property and/or buy it. Furthermore, there is more commerce. Larger companies move here. More retail is in the area, more schools. The list goes on and on. Second is asset type. Apartments are going to drive a lower cap rate than an office building. The reason for this has to do with risk. Apartments are considered lower risk because they are stable and stay fairly occupied in good and down times. The asset type will bring a cap rate based on the strength of the cash flow or lack thereof. Third is the condition of the property. Something that is old and dilapidated will drive a higher cap rate as it is riskier. Chances are you will have to put more money into the property, which is more risk. Conversely, a new property is brand new. Then the operating costs go down because there is little to no maintenance. Fourth are the interest rate environment. If buyers are paying cash, this is irrelevant, but most people are going to borrow money. The interest has a big impact because the higher the interest rate, the more it puts a constraint on purchasing power. Let's say you're buying a property for $2 million and the cap rate is 4%. This means that your net cash flow is $80,000 a year. You want to borrow 70% loan to value, which means your loan is $1.5 million. Let's assume your rate is 3.5% and your amortization is 30 years. This means your payment is $80,828. If you take a debt service coverage ratio, it would be 80,000 divided by 80,828, which is 0.98. Now remember, you need to be at 1.20, so this won't work. Let's take a new scenario with everything being the same except the interest rate. If the rate changed to 2%, then your payment would be $66,531 a year, and your debt service coverage rate is 1.20. The way this affects the cap rate industry is that if the interest rates remain high, then the cap rates will eventually have to change. The reason is that there is only so much someone can infuse as a down payment. At some point, the demand for the properties goes down and the supply goes up. Therefore, the prices will lower. This isn't a guarantee, but it is pretty consistent to historical trends. The final element is the overall economic health. If things get worse in the economy, i.e. jobs, inflation, wars, pandemics, terrorist attacks, and the like, anything that slows or stops the U.S. economic engine can impact the cap rate. As the economy becomes more risky, then cap rates can tend to get higher. If spending goes down, then less people are shopping, which means tenants are making less money and can't afford rent. This means tenants' profits go down and they can't pay as much rent. Buyers are not willing to pay as much, therefore prices come down. This lowers the rent and therefore can lower the prices of the properties. As you can tell, the cap rates have a lot that goes into them. It is really important to understand that cap rates are relative. The market can really dictate what cap rates are at any given time in the cycle of the economy.